Imagine the universe, vast, mysterious, and governed by fundamental forces. Our economic lives are not so different. They too dance to the rhythm of a powerful force: interest rates. Just as gravity shapes the cosmos, interest rates shape our financial world. They influence the cost of borrowing, the return on savings, and the overall health of our economy. Like celestial bodies locked in an intricate dance, these rates are constantly moving, shifting, and influencing each other. Understanding this cosmic dance of money and rates is essential for navigating our financial lives. It empowers us to make informed decisions, anticipate economic trends, and understand the forces shaping our financial future. So, let's embark on a journey to explore this fascinating realm, where economic principles intertwine with the flow of money, guided by the invisible hand of interest rates. At the heart of our financial system sits the Federal Reserve, often called the Fed. Like a conductor leading a grand orchestra, the Fed sets the tempo for the economy by influencing interest rates. But unlike a traditional conductor, the Fed doesn't directly control the instruments. Instead, it uses a variety of tools to influence the flow of money and credit, nudging interest rates in the desired direction. One of their most important instruments is the federal funds rate. This is the interest rate that banks charge each other for overnight loans. By adjusting this rate, the Fed sets off a chain reaction that impacts interest rates throughout the economy. Understanding the Fed's role is crucial to grasping the bigger picture of interest rates. Their decisions reverberate throughout the economy, affecting everything from the price of a cup of coffee to the trajectory of the stock market. Imagine the federal funds rate as the foundation of a massive musical pyramid. At the base lies this crucial rate, set by the Federal Reserve. It's the bedrock upon which all other interest rates rest. This rate dictates how much banks charge each other for short-term loans. Seems simple, right? But this seemingly small rate sends ripples throughout the entire financial system. When the federal funds rate rises, borrowing becomes more expensive for banks. They, in turn, pass on this increased cost to consumers and businesses in the form of higher interest rates on loans and credit cards. Conversely, when the Fed lowers this key rate, borrowing becomes cheaper, stimulating economic activity. This intricate interplay between the federal funds rate and the broader economy is a testament to the interconnected nature of our financial system. Let's embark on a journey through time, tracing the path of the effective federal funds rate, Fed funds, like astronomers charting the course of a distant star. This historical perspective reveals fascinating patterns and insights into the forces that have shaped our economy. Looking back over the decades, we see periods of both stability and volatility. The Fed funds graph shows us times of economic prosperity, where the rate remained relatively low, fueling growth and expansion. But we also witness periods of economic turmoil, like the financial crisis of 2008, where the Fed slashed rates to near zero to prevent a complete collapse. These historical peaks and valleys paint a vivid picture of how the Fed has used the federal funds rate to navigate economic storms and steer us towards calmer waters. By studying these past trends, we gain valuable insights into how the economy might react to future changes in interest rates, much like astronomers use past observations to predict celestial events. Section 5. The current crescendo, a symphony. Reaching a fever pitch. In the current economic symphony, the music seems to be reaching a crescendo. The Fed funds rate, after a prolonged period of remaining near zero, is now on an upward trajectory, sparking concerns about the potential consequences. This recent surge in rates, a response to rising inflation, has many worried about the potential for an economic slowdown. The once harmonious melody of low interest rates is giving way to a more discordant tune as borrowers face higher costs and businesses grapple with increased borrowing expenses. Some economists argue that this tightening of monetary policy is necessary to tame inflation and prevent the economy from overheating. Others fear that the Fed might overreact, pushing rates too high and inadvertently triggering a recession. As we listen intently to the unfolding symphony of the economy, the question remains, will the Fed find the right balance, orchestrating a soft landing, or will the music come to a sudden halt? Section 6. Ripples in the space-time continuum, interest rates and loans. Just as a stone thrown into a pond creates ripples that spread outward, changes in the federal funds rate create a ripple effect throughout the entire financial system. one of the most immediate and significant impacts is on the interest rates of loans. Think of loans as the threads that connect borrowers and lenders in the fabric of the economy. When interest rates rise, these threads tighten, making it more expensive to borrow money. For individuals, this translates into higher interest rates on everything from car loans and credit cards to student loans. Businesses, too, feel the pinch as they face higher costs for securing loans to fund their operations and investments. These ripple effects can have a profound impact on consumer spending, business investment, and ultimately, the overall health of the economy. Section 7. Galactic real estate mortgages in the expanding universe of rates. Nowhere is the impact of rising interest rates felt more acutely than in the vast universe of real estate. Mortgages, the financial vehicles that propel homeownership dreams, are highly sensitive to fluctuations in interest rates. As interest rates rise, mortgage rates follow suit, making it more expensive to finance a home purchase. This can price potential homebuyers out of the market, cool down demand, and even lead to a decline in home values. Imagine the housing market as a distant galaxy, with mortgage rates acting as the gravitational force that holds it together. When rates rise, the gravitational pull weakens, potentially sending the market into a spin. Understanding the intricate relationship between interest rates and the housing market is essential for anyone looking to buy, sell, or invest in real estate. Section 8. Cosmic inflation, the expanding and contracting universe of prices. Inflation, the persistent increase in the general price level of goods and services, is a cosmic force that affects us all. And just like the expanding universe, it can be a powerful and relentless force. One of the Federal Reserve's primary mandates is to keep inflation in check, ensuring that prices remain relatively stable. They do this by adjusting the federal funds rate, using it as a tool to either stimulate or cool down the economy. When inflation runs too hot, the Fed typically raises interest rates to curb spending and borrowing, thereby slowing down the rate of price increases. Conversely, when inflation is low, they may lower rates to encourage economic activity. This delicate balancing act between inflation and interest rates is a testament to the complex challenges faced by central bankers in their quest to maintain a stable and healthy economy. Section 9. The delicate balance, economic growth and the cosmic playground. Economic growth, the lifeblood of any thriving economy, is a delicate dance between various factors, with interest rates playing a pivotal role. Like a cosmic choreographer, the Federal Reserve tries to strike a balance, fostering growth without igniting the flames of inflation. When interest rates are low, borrowing becomes cheaper, encouraging businesses to invest, expand, and hire more workers. Consumers, too, are more likely to make big-ticket purchases, further fueling economic activity. However, if growth becomes too rapid and inflation rears its head, the Fed may step in and raise interest rates to cool down the economy, preventing it from overheating. This delicate balancing act is essential for sustained long-term economic growth. Understanding this delicate interplay between interest rates, inflation, and economic growth is crucial for policymakers, businesses, and individuals alike. Section 10. Navigating the cosmos of interest rates, a survival guide. Navigating the complex world of interest rates can seem daunting, but armed with knowledge and understanding, we can all become savvy cosmic travelers in this ever-changing landscape. Start by staying informed. Pay attention to economic news, track interest rate trends, and familiarize yourself with the Federal Reserve's actions and statements. Knowledge is power, especially in the realm of finance. When making financial decisions, consider the potential impact of interest rates. If you're planning to take out a loan, explore different options and compare rates from various lenders. For savers, seek out accounts that offer competitive interest rates to maximize your returns. By being proactive, informed, and adaptable, we can all navigate the cosmos of interest rates with confidence and make sound financial decisions that align with our goals. Section 11. Epilogue. Our intertwined destiny with interest rates. As we conclude our cosmic journey through the world of interest rates, one thing remains clear. Our financial destinies are inextricably linked to these powerful forces. Like celestial bodies locked in an intricate gravitational dance, interest rates influence our lives in countless ways, shaping our borrowing costs, our investment returns, and the overall health of the economy. While the complexities of interest rates may seem daunting, understanding their fundamental principles empowers us to make informed financial decisions, navigate economic uncertainty, and secure our financial well-being. So, let's embrace the challenge of comprehending these cosmic forces, for in doing so, we gain a deeper understanding of our financial lives and the intricate workings of the global economy.